If you're holding silver, Kevin Warsh just did the unexpected. What if the biggest move in the silver market this year didn't come from a mine, a shortage, or a war, but from 11 words spoken quietly on a stage in Portugal? Most investors were watching the jobs report. Most investors were watching interest rates. But almost nobody was watching Sintra. And that's exactly why what happened there caught the entire silver market off guard. Because the man who was supposed to be silver's biggest threat just became something else entirely. Promise. By the end of this video, you'll understand exactly what Kevin Warsh said this week that sent silver climbing again. You'll understand why the man Wall Street feared most in January is now the same man gold and silver are quietly reacting to in July. You'll see the pattern connecting 5 separate moments this year, moments most retail investors never connected, and you'll walk away knowing exactly which signal to watch next before the next headline forces everyone else to react. This isn't speculation, this is a pattern hiding in plain sight. Let's start with where we are right now. This morning, silver opened near $60 an ounce, moving higher after a softer than expected June employment report. Silver September futures opened at just $59.75 per ounce on Thursday, July 2nd, 2026, with prices climbing following the weaker than expected June jobs report. It's a modest move on the surface, but the reason behind it is anything but modest. One day earlier in Sintra, Portugal, Federal Reserve Chair Kevin Warsh stood on stage at the European Central Bank's annual forum and said something that shifted the entire tone of the metals market. Warsh spoke at the ECB Forum in Sintra on July 1, 2026, telling attendees that inflation remains too elevated, even as Fed officials have grown more open-minded about AI's potential deflationary effects. Gold responded immediately, climbing back above $4,000 an ounce. Silver moved even faster. Gold climbed back above $4,100 an ounce, rising roughly 1.65%, while silver moved even faster, up nearly 3% to just over $60. To understand why that matters, you need to rewind 5 months, because this isn't the first time Kevin Warsh has moved this market. It's the fourth. On January 30th, 2026, President Trump announced that Kevin Warsh would become the next chair of the Federal Reserve, replacing Jerome Powell. Within hours, the metals market didn't just react, it convulsed. Gold fell as much as 16% intraday before recovering. Silver did something almost nobody alive had seen. It plunged nearly 40% from its recent peak in a single trading session before clawing back part of the loss by the close. Spot gold prices fell 16% from their highs before bouncing back toward $5,000, while silver crashed a stunning 39% from its recent peaks, erasing its year-to-date gains before recovering above $85. Silver's single-day decline was later described as its worst trading day since March of 1980. Spot silver plunged nearly 31.4% on that Friday, its worst day since March 1980. Why would the announcement of a single central banker cause a crash of that size? Because Warsh wasn't an unknown name. Investors already had a file on him. Historical comparison. Kevin Warsh served on the Federal Reserve's Board of Governors from 2006 to 2011, the years surrounding the global financial crisis. He was in the room, and when he left, he didn't leave quietly. He became one of the loudest critics of the very institution he had served, publicly opposing the Fed's bond-buying programs and pushing for a stronger dollar. Warsh vocally opposed quantitative easing during his earlier Fed tenure and has long favored a stronger US dollar, a stance traditionally seen as bad news for silver because dollar-denominated commodities become more expensive for foreign buyers as the currency strengthens. That history is precisely why traders panicked in January. A hawkish Fed chair, historically, means higher rates. Higher rates mean a stronger dollar. A stronger dollar means gold and silver, assets that pay no yield, suddenly look less attractive to hold. Silver's crash on nomination day was so severe that Wall Street strategists compared it to a meme stock unwind rather than a normal commodities correction, pointing to extreme leverage in the futures market as the real accelerant. One market strategist described the move as reminiscent of a meme stock unwind, noting that high leverage and significant volatility created the conditions for a cascading sell-off as traders rushed for the exit simultaneously. Silver's single-day drop of 27% was, at the time, its steepest decline since 1980. Silver plunged 27%, marking its steepest one-day decline since 1980. But here's where the story most people tell you stops, and where it actually gets interesting. Expert explanation / turning point number 1. Warsh was confirmed by the Senate in the spring. By April, as his confirmation hearing approached, silver was still trading in a nervous holding pattern near $78 an ounce, with investors listening less for what Warsh would do and more for how he would do it. Markets were not simply waiting to see whether Warsh would be confirmed. They were listening for whether he would govern the Fed as an independent steward of policy or bend to political pressure from the White House. That distinction, independence versus political pressure, became the entire story of 2026. President Trump made his own expectations public, saying on television that he would be disappointed if Warsh didn't move quickly toward rate cuts once confirmed. In a television interview, the president said he would be disappointed if Warsh failed to move quickly on rate cuts once confirmed. For a market built on the assumption that central banks operate above politics, that single comment introduced a new kind of uncertainty, one that had nothing to do with inflation data at all. Market psychology. Here's what most retail investors miss about moments like this. They watch price. Smart money watches posture. Every time Warsh spoke, the market wasn't just pricing in what he said, it was pricing in what kind of Fed chair he was choosing to be. A rubber stamp for political pressure, or an independent check on it. That's why his very first Federal Open Market Committee meeting as chair, held on June 17th, became such a pivotal moment. The Fed held rates steady at 3.50 to 3.75%, exactly as expected. The June 17th meeting kept the federal funds rate parked at 3.50% to 3.75%, which was widely expected. But it wasn't the rate decision that moved the market, it was what came with it. 9 of the 19 Fed officials signaled they now expected at least one more rate hike before year-end, pushing the median year-end rate forecast from 3.4% up to 3.8%. 9 out of 19 officials forecast at least one rate hike by the end of 2026, pushing the median year-end rate outlook from 3.4% to 3.8%. Gold, silver, and Bitcoin all fell together as the dollar strengthened on those hawkish projections. And in a break from a decade of Fed tradition, Warsh chose not to submit his own individual forecast alongside the committee's dot plot at all. Warsh broke with over a decade of tradition by declining to submit his own economic projections alongside the committee's. Unlike his predecessors Jerome Powell and Janet Yellen, who always included their individual forecasts. Think about what that means. The market couldn't read him. And uncertainty, in a market this leveraged, behaves exactly like bad news. Retention transition / turning point number 2. That's only part of the story, because 2 weeks later, the same man who had just spooked the market with silence did something almost nobody expected. The unexpected move. On the stage in Sintra, in front of central bankers from around the world, Kevin Warsh finally showed his hand. He didn't abandon his inflation-fighting stance entirely. He still called inflation too high. But for the first time since taking the chair, he acknowledged that the risks around inflation had eased. Gold and silver jumped after Fed Chair Kevin Warsh softened his hawkish tone at the ECB's Sintra Forum. He also talked openly about something almost no Fed chair discusses on a global stage, the possibility that artificial intelligence could act as a deflationary force on the economy, easing the very pressure he'd spent months warning about. Warsh said Fed officials have grown more open-minded about AI and its implications for being deflationary, even while maintaining that inflation remains too elevated. For a man Wall Street had spent 5 months labeling the second coming of Paul Volcker, that was the unexpected move. Not a rate cut, not a policy announcement, just a shift in tone. From a man whose tone had already crashed silver 40% once before. Markets noticed immediately. The very next morning, private payroll data came in weaker than expected, adding fuel to the shift. The ADP report showed private payrolls slowed to 98,000 in June, down from 122,000 in May, a second data point pointing the same direction as Warsh's softened tone, toward easing rather than tightening. By Thursday morning, silver had climbed to its highest level in over a week, brushing past $62 an ounce. Silver hasn't opened above $60 since the previous Wednesday, and hasn't moved above $62 since the previous Tuesday, before climbing to $62.10 this morning. Here's what smart money is actually watching, and it isn't Warsh's words at all, it's the math underneath them. The Fed's own balance sheet expanded in the weeks after Warsh took the chair, even as he talked tough on inflation. The Fed's own balance sheet expanded in the weeks after Warsh took the chair, and with the M2 money supply sitting near $22.8 trillion as of this spring, M2 stood near $22.8 trillion as of April 2026. There's a structural argument that no Fed chair, however hawkish his reputation, can sustain aggressive tightening indefinitely without straining an economy this leveraged. If that argument holds, Warsh's softened tone in Sintra wasn't a policy U-turn. It was the math quietly asserting itself. That's the case some analysts are now making for holding gold and silver, not as a bet against Warsh, but as a hedge against the fiscal reality he's operating inside of, regardless of what he says on any given Wednesday. If you're finding this breakdown valuable, take a second to subscribe to John A.G. Wealth. Every week, we connect the dots between Fed policy, precious metals, and the signals most channels miss entirely before they become tomorrow's headlines. And if this analysis is helping you see the bigger picture, hitting the like button helps more serious investors find this instead of noise. So where does this leave silver from here? Right now, futures markets are pricing in less than a 30% chance the Fed raises rates at its late July meeting. Currently, there's less than a 30% chance the Fed raises rates following its meeting at the end of July, according to the CME Group's FedWatch tool. That's a meaningful shift from the hawkish dot plot investors were bracing for just 2 weeks earlier. If the data continues to soften, if labor numbers keep missing and inflation keeps cooling, Warsh's Sintra comments may end up being remembered as the moment the tone genuinely turned. If instead inflation proves sticky, as some economists still expect, a strong labor market could keep the Fed higher for longer, which would likely cap silver's near-term upside. A solid labor market and sticky inflation are likely to prompt the Fed to keep interest rates elevated for longer, which could limit further growth in silver prices in the coming months. Neither outcome is guaranteed, but the pattern is now visible for anyone paying attention. Every time Warsh's tone shifts, silver moves first and moves fast, in either direction. Signals to watch. So what should you actually be watching going forward? First, Fed communication, not just Fed decisions. Warsh has already shown that a change in tone can move silver as much as a change in rates. Second, the labor data. Both the ADP report and the broader jobs numbers have been the second half of every recent silver move this year. Watch them together with what Warsh says, not in isolation. Third, the FedWatch probability for the Fed's late July meeting. As that number moves, so will the metals complex. And fourth, the Fed's balance sheet itself. If it keeps expanding while Warsh talks tough, that's the tell that the underlying math is doing more of the work than the rhetoric. Here's a question for you. Do you think Kevin Warsh's shift in tone at Sintra was a genuine change of heart on inflation, or simply the fiscal reality of the Fed's own balance sheet catching up with him? Would you be buying silver on this move, waiting for more confirmation, or staying on the sidelines entirely? Let me know in the comments. I read every one. 5 months ago, Kevin Warsh's name alone was enough to crash silver 40% in a single session. This week, a handful of careful words from the same man helped push it back toward multi-week highs. That's not a contradiction. That's the market learning in real time that a Fed chair's reputation and a Fed chair's actual constraints are two very different things. Reputation moves prices in the short term. Math moves them in the long term. And right now, the math, a swelling balance sheet, a labor market losing steam, a money supply north of $22 trillion, is starting to speak louder than the label anyone put on Kevin Warsh back in January. Markets rarely reward those who react to headlines. They tend to reward those who recognize the signals before they become obvious. Kevin Warsh spent 5 months being priced as silver's biggest threat. This week, he became something closer to its quiet ally. Not because he changed who he is, but because the numbers underneath him left him little choice. The real question isn't whether the Fed's tone will shift again. It will. The real question is whether you'll recognize it in time. If you found this analysis valuable, subscribe to John A.G. Wealth for more in-depth market breakdowns. Like this video if it helped you see the market differently, and share your thoughts in the comments below. And if you want to stay one step ahead, watch the next video on this channel, because the next signal may already be forming.